Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge etc. Mutual funds, tracing their evolution through history. Early origins, 1700s to 1800s. 1774, the first pool investment vehicle known as Endragd Marketing Managed Unity Creates Strength was launched in the Netherlands by Abraham van Keetwijk. This was the precursor to modern mutual funds. 1800s, investment trusts spread across Europe, primarily in England, allowing investors to diversify risks across various companies and regions. The birth of modern mutual funds, 1920s to 1940s. 1924, the first modern mutual fund, Massachusetts Investors Trust (MIT), was established in the United States. It offered daily liquidity, allowing investors to buy and sell shares. By the end of 1924, MIT had attracted 200 investors and 392,000 dollars in assets. 1928, Wellington Fund became the first mutual fund to include both stocks and bonds, introducing the balanced fund concept. 1929, the Wall Street crash caused a decline in investors' confidence, affecting early mutual funds. 1940, the Investment Company Act of 1940 was passed in the US, establishing a regulatory framework for mutual funds. It mandated transparency, investor protections, and regular disclosures, setting the stage for modern growth. Post-war expansion, 1950s to 1970s. 1950s, mutual funds began to gain popularity in the US as the economy grew and middle-class Americans sought investment opportunities. The number of funds increased from 73 in 1950 to over 150 by 1960. 1970s, introduction of money market mutual funds, such as the Reserve Fund in 1971, provided investors with a safe and liquid alternative to savings accounts. 1974, the establishment of the Individual Retirement Account (IRA) in the US allowed mutual funds to attract long-term retirement investments. 1976, Vanguard introduced the first index fund, Vanguard 500 Index Fund, which mirrored the performance of the S&P 500 and paved the way for passive investing. Global growth and innovations, 1980s to 1990s. 1980s, mutual funds experienced explosive growth due to technological advancements, improved accessibility, and rising financial literacy. Mutual funds started to expand globally, with companies launching funds tailored to European and Asian markets. 1990s, the mutual fund industry entered a golden age with the rise of the internet, allowing easier access and management. Assets under management (AUM) in US mutual funds grew from $1 trillion in 1990 to $4 trillion by the end of the decade. The introduction of target date funds helped investors manage retirement investments more effectively. The 21st century, 2000s to present, 2000 to 2010, the rise of exchange-traded funds (ETFs) offered an alternative to traditional mutual funds, combining mutual funds diversification with stocks liquidity. The 2008 financial crisis tested the resilience of mutual funds, leading to enhanced regulatory measures. 2010 to present, mutual funds expanded into niche markets such as thematic funds, example technology, healthcare, and ESG funds focused on environmental, social, and governance principles. Digital platforms like Robinhood, Grow, and Zeros have simplified mutual fund investments, attracting younger investors. 2020, despite the pandemic, mutual funds saw record inflows due to retail investors' increased interest in stock markets. The global mutual fund industry today. A detailed overview. Size and scale of the industry. The global mutual fund industry manages assets worth trillions of dollars, with the US being the largest market as of recent data. Total assets under management exceed $70 trillion globally. Market leaders, the United States, Europe, and Asia Pacific are the dominant players. Growth drivers include increasing financial literacy, regulatory support, and a growing middle class population in emerging economies. Regional insights. United States. The US accounts for over 40% of the global mutual fund market. Key features. Dominance of equity funds, followed by bond and money market funds. Strong regulatory framework under the Securities and Exchange Commission (SEC). Presence of major players like Vanguard, BlackRock, and Fidelity. Trends: rise in passive investing through index and exchange-traded funds (ETFs), increasing use of robo-advisors for portfolio management. Europe: Europe contributes significantly to global AUM, with countries like Luxembourg, Ireland, and the UK being fund hubs. Characteristics: preference for mixed asset funds, combination of equity and fixed income. Growth of sustainable and ESG (environmental, social and governance) funds. Asia Pacific: rapid growth driven by markets like China, India, and Japan. Features: increasing penetration of mutual funds in emerging economies. Preference for fixed income and balanced funds in developing nations. Japan's focus on low-cost funds and ETFs. Emerging markets: Latin America, Africa, and parts of Asia show promising growth. Drivers: rising financial inclusion, government initiatives to promote investment products, increasing adoption of digital platforms. Key industry trends: passive investing, significant shift from actively managed funds to passive funds like index funds and ETFs. Benefits: lower cost, transparency, and consistent performance against benchmarks. ESG and sustainable funds, significant shift from actively managed funds to passive funds like index funds and ETFs. Benefits: lower cost, transparency, and consistent performance against benchmarks. Technology integration, digital platforms and robo-advisors simplify access to mutual funds, enabling real-time tracking and lower operational costs. Use of AI and big data analytics in fund management to improve performance and risk assessment. Customization and thematic funds. Rise of thematic funds focusing on sectors like technology, healthcare, renewable energy, and cryptocurrency, targeted towards niche investor groups with specific interests. Regulatory changes, increasing emphasis on transparency, investor protection, and fee standardization across regions. Stricter guidelines for ESG labeling and disclosures. Challenges facing the industry: market volatility, economic uncertainties, geopolitical tensions, and inflation concerns impact fund performance. Active funds struggle to outperform benchmarks during turbulent times. Fee compression, rising competition, and the popularity of low-cost passive funds force traditional fund houses to reduce fees. Pressure on profit margins for fund managers. Investor education. Despite growth, many markets, especially in emerging economies, face challenges in financial literacy. Misconceptions about risk and returns hinder mutual fund adoption. Regulatory hurdles. Constantly evolving regulations require fund houses to adapt quickly, increasing compliance costs. Role of technology in transformation. Digital onboarding. Streamlined account opening processes through apps and online platforms. AI and machine learning used for predictive analytics, personalized recommendations, and fraud detection. Blockchain enhances transparency and security in fund transactions. Big data helps fund managers analyze market trends and make data-driven decisions. Future outlook. Expansion in emerging markets. Countries like India, China, and Brazil are expected to drive the next wave of growth due to increasing financial awareness and digitization. Sustainability focus. ESG funds will likely dominate new fund launches as regulatory frameworks and investor preferences align with global sustainability goals. Innovation in products. Introduction of hybrid funds, smart beta ETFs, and blockchain-enabled funds to cater to diverse investor needs. Fee reduction. Competition and regulatory mandates will continue to push fund houses toward cost efficiency. Major players in the industry. The global mutual fund landscape is dominated by some key players. BlackRock, Inc. shares, the largest asset manager known for its ETFs and index funds. Vanguard Group, a pioneer in low-cost passive investing. Fidelity Investments, strong presence in active and passive fund management. State Street Global Advisors, known for institutional offerings and ETFs. JP Morgan Asset Management, expertise in actively managed funds and global diversification. Leading mutual fund companies in India. SBI Mutual Fund, HDFC Mutual Fund, ICICI Prudential Mutual Fund, Axis Mutual Fund, Aditya Birla Sun Life Mutual Fund, Nippon India Mutual Fund, UTI Mutual Fund, Kotak Mahindra Mutual Fund, Mira Asset Mutual Fund, Franklin Templeton Mutual Fund. Leading mutual fund companies globally. BlackRock, Inc., Vanguard Group, Fidelity Investments, State Street Global Advisors, SSGA, JP Morgan Asset Management, Capital Group, American Funds, Franklin Templeton, PIMCO, T. Rowe Price, Amundi Asset Management. Thank you very much for your patience.